Welcome to this week's edition of Selfwealth Live, here with myself, Roger, and Jason McIntosh. We had a week off last week because of the Melbourne Cup down here. Did you have a punt at all, Jason?
Yeah. We did the family sweep. Got all the kids around, hand in the bucket, pulled out some horses, pulled out some names,
That's
and
good.
always a bit of fun.
Fantastic. And there's also a big cup up. There's also a big the Randwick. I think there's the Randwick up there in Sydney as well, isn't there? Do you bet on that or just the
Yeah,
Melbourne?
always a good spring carnival up here in Sydney, and enjoyed many good days out at Randwick over the years. It's look, it's just a spectacle. I don't have so much to bet anymore because I enjoy, I'm focused on the markets, and that's where I get my interest in putting money on the line there. So when I go to the races, it's really just a bit of fun catching up with the friends.
Yeah, fantastic. All right, that's good to hear. Well, I'm glad you had some fun and had a last week off off our call, right? So this week we've got some interesting questions. We do have a few questions from the crowd, which is it's great. It's great to have that feedback come in. It's great to see people really interested in our sessions, Jason. So once again, I appreciate you, mate, and I appreciate our clientele, our people that are on the call here, the people on the YouTube. Sending in questions. It's fantastic, right? It's good to hear. But before we move on, Jace, do you mind going through your spiel, please?
Yeah. Look, we'll just give a bit of a disclaimer. So everything we talk about today is general advice only. Nothing personal. Nothing tailored to anyone. So you've got to go and get your own personal advice if you need clarification on anything. And just quickly putting up the disclaimer. And again, that's just saying this is general commentary only. And the other point to make is that I'm not part of Selfwealth. I'm part of Motion Trader. That's my business, and I come together with Rog and talk about markets generally, and all my license details are in that disclaimer there.
Fantastic. Yep. Now, before we go on, Jason, obviously we're going to talk a little bit about some negatives of trading this year. Negatives trading in your history, and that is once again what's your biggest losing streak, all right? Which is kind of not what everyone wants to hear sometimes, right? But I think the reality of trading is, and we're in a time that it can happen at the moment where, as trend traders, we sort of we struggle a little bit. Trying to catch that wave, trying to catch the right trend, and with a lot of stops getting hit. So sometimes some of the information is going to come out with our call today is going to be really timely once again, just to sort of think about, you're not the only one that might be experienced. If you're a trend trader and you experience a lot of hits, stop loss hits, you're not the only one in that position, and times will turn around eventually, right? So but before we get on to some of this, Jace, look, I'm going to get straight into our first question here from Michael, and that is, could you please comment on your preference for companies which pay or don't pay a dividend in relation to Motion Traders' strategy or in general? Does one group tend to be better than the other, or is there no difference?
Yeah, look, it's a really interesting question. It's when I back test and I'm coming up with my strategies, I'm not including dividends in the process. I'm looking at stocks from a trending and a momentum perspective. I'm using moving averages. I'm using breakouts. I want to see the movement in the share price, and that's how I'm building my systems, and that's how I'm managing my portfolio. But the interesting thing is, so it's like a company that's going up in value. It's going up in value because people are buying it. They want to own it, and it's most likely because the company is doing something well. And if the company is doing something well, they're making money, and then they're most likely paying dividends. So dividends tend to be a byproduct of looking for that strength in the share price. So it's interesting when I look at my own portfolio on the breakdown of it, and I was looking at it this morning just to get a feel around some of the numbers, and around 25% of my profit over the last 10 years or thereabouts has been from dividends. So dividends really do make up an important part. And I'll just show you what I mean. I'll just share my screen. I'm just going to switch websites at the moment. So I've got TradingView up there at the moment. Let me just jump over to the Motion Trader website for a sec. And hang on, let me just cancel. I was on the wrong one. Here you go. Now let me just jump screens. And I'm just going to go into the About section on the Motion Trader page and the Jason's portfolio section, and you just see this come up now. So just scroll down, and this is like this. This tracks the value of my portfolio, and you can see this equity curve going back to October 2015 when I started this standalone Motion Trader portfolio, which I run, and so that equity curve you can see there, 25% of that is made up of dividends. So the capital gain is the main thing that I'm going for when I'm analysing a stock I'm putting on a position. But as I was saying, that byproduct of a company doing well is that you often pick up those dividends. So it makes up a significant part of what I'm doing. So I just go back to TradingView. I've got a couple of examples of what I mean. Now, let me just get those charts back. I'll show you a couple of individual stocks. When I was going through some stats, it turned out, so one of my best dividend-paying stocks over the last 10 years or so has been this company here called Jumbo Interactive. So this is an old trade which I had a few years ago. Haven't been in it during this period here where the price hasn't been doing much. Just going to compress the price action a bit, and so you can look all the way back here, this green circle. That's where I bought a position in 2017. I bought on the basis of this upward momentum, not because of the fundamentals, not because of the dividend, but because of the strength of the trend and the momentum in the share price. So Jumbo Interactive, it's a lottery reselling business, and turns out the business was doing quite well. That's why the share price is going up. And it turns out they paid quite a bit of dividends. So this is actually the fourth highest dividend-paying stock I've had in my portfolio over the last 10 years. These are some of the things we've spoken about over the weeks gone by, staying with trends. So I rode this trend all the way up, rode it to the peak, took some profit as the shares started to break down that first green circle, and then the second green circle where it hit the trailing stop, got out of the lot. But that was a great momentum trade, brought a lot of capital gain. So it's up over 500%, a lot of capital gain, but also paid a significant dividend along the way. Now, I want to contrast that with another one of my top performers, which has been in my portfolio, and also, it's like, of course, it's a Motion Trader stock. That's why it's in my portfolio. It's this company here. It is Calix Limited, CXL. And again, I've got it's this great entry back here where we've got the moving averages turn, buying into strength, breaks above some previous peaks. I get an entry point, stock runs, let the trend run, give it room to move, see off all these consolidations and pullbacks we have along the way. Eventually get out over here I think it was almost 2 years later. So it's a two-year trend. Calix, unlike Jumbo, doesn't pay any dividend. So this was around a 500% return as well, but no dividend payer. So as to the question, do dividend stocks or non-dividend stocks do better? And I think that if you're a trend trader and you're following momentum, the dividend doesn't have to be a key criteria. It can be. You might like dividend stocks, but it doesn't need to be, because you can do very well out of a trend whether the stock pays dividends or not. But if the stock is doing well, there's a good chance that it is going to be paying some sort of dividend. So it's look, it can be a decent part of a return.
That's good to know. So I mean, at the end of the day, you don't really look at. Let's say you put the trade on, you're not really fussed if it pays a dividend. It's more of a bonus. That's what you're sort of saying. Is that right? More of a bonus.
Pretty much. That's how it's been for me. It's
Mm,
and it's a very nice bonus as well,
mm,
and it's a bonus that I expect to get. So if I've got a portfolio of up to 80 stocks, the majority of those are going to be paying some sort of dividend
yeah.
because they're businesses which are doing well. That's why the share prices is going up, and it's I don't go hunting for dividend stocks in particular, but I buy a stock in the knowledge that most of them will pay a dividend, unless of course you're looking at speculative mining stocks, which doesn't tend to be a significant part of my portfolio.
Yeah, and just another question, actually, which I've sort of thought of at this. Do you participate if the company offers reinvestment plans, or do you just put it back in cash and buy more shares with that? How do you sort of manage that?
Yeah, I don't do the different reinvestment plans simply
Yeah,
because I think they're great. It's interesting. I've got the in New South Wales we have NRMA being the roadside service business, and they issued shares to all their members 30 years ago, something like that. It's now part of IAG, the big insurance group, and so then my NRMA shares became IAG shares. And so I got these 30 years ago. It was like $500 worth of shares, and I've just kept them. I've just kept them for the last 30 years. It's not nothing too exciting. It was just an experiment to see, well, what would happen if I held on to something and did dividend reinvestment each year, and that's what I've done. So $500 worth of shares is, I know, might be now worth $5,000 worth of shares. So it's been an interesting exercise in compounding. But that's not typically what I do with my motion trader portfolio of stocks. It'll be, I'll take the dividends and that'll go back into capital, which can then be used to buy new shares in companies which are giving entry signals. Because the thing is, you can get a dividend reinvestment plan if you're a long-term investor. That probably works. But if you're an active investor and you're exiting stocks as they start to hit their trailing stop or their exit point, it may not make sense to have a dividend reinvestment plan active because you may be buying shares just near the time you're going to be exiting. So
mm,
that's why I prefer to have the money just go back into the general allocation of capital, which will go into the later signals. But depending on what you're doing, it always depends what's right for you, what you're doing, what your goals are. The dividend reinvestment plans can be really good. The same with share purchase plans,
yeah,
which will come out. I'll often get those. Those will often come out, and the way I treat those is I'll wait until close to the end date, and then just see, well, where's the current share price versus the price I can get into with the share purchase plan. Sometimes you're able to buy it at a nice discount, maybe 10% or 15%. And I might then take the full allocation, and I could hold them or I could sell them soon after, but just for that quick windfall gain. So handling different situations depending on the very much on the circumstances.
yeah. No, I'm glad and also exactly that goes on to share purchase plans, how you manage them, also like rights issues and things like that. You generally, it's just on a case by case basis, I'm assuming, but it's not like a hard and fast rule, right? So
Yeah, it all depends. Where can I get in through the corporate action
yeah,
versus where the share price is now? If I'm getting
yeah,
in at a good disc, if I'm getting in at a 2% discount, I'll let it go because the market will probably move more than 2% before I can actually do anything with the shares, either up or down. So it's too much risk
yeah.
unless I really want to get into the position.
Mm.
So then I'd let it go. I'd want that nice margin to make it for me, make it worthwhile.
Make it worth it. Yep. I think this question actually just come in, which is kind of relevant, right? So I think we'll go to this question here. How do you adjust movement of stocks that happens due to ex-dividend? Do you treat it as part of the same moving average or adjust it?
Yeah, well, the ASX, the way the ASX manages this, if it's a special dividend, they'll make an adjustment to the share price. So you might have a company that does a capital return, and it's a $2 company, and they do a $1 capital return because they've just sold a big asset. So you look at the chart, and it's fallen $1 a day. But it's not a real fall. It actually hasn't lost $1 of value because you've got a check in the mail for $1 per share coming your way. So in that case, ASX will make an adjustment. So there'll be an adjustment factor which is sent out to the data providers who are managing that, and so that gap will disappear from the share price. And so it doesn't affect the moving averages. If it's your regular dividend, you've got a $2 share and it pays a 10-cent dividend, well, then you will have a drop on the chart, but that's then just absorbed into the price action. It's not standard practice to make adjustments for ordinary dividends. They all just flow through the data.
Yeah. And so you're saying when it went ex-div and the share price closed below your, I don't know if you've had this example before, but if the share price closed below your trailing stop, knowing that it's just gone ex-div, would you stay in or would you exit?
Exit, because according to the data, it's hit the trailing stop, and there's not going to be an adjustment factor. Anyone can use discretion in these matters. But for me, I'd sell it, because it's also, to be that close to the trailing stop, it's been trending down for a period anyway. So it's not like a stock which is in an uptrend and hitting new highs isn't going to hit its trailing stop on ex-dividend, because it's so far away from your trailing stop if you're using a wide trailing stop. The only way that's going to trigger is if the stock is been in decline anyway. So it's not a situation I can even remember coming across. But theoretically, yeah, by all means, it could happen. But for me, I think it'd be an exit event. I wouldn't want to just keep holding a stock which has been struggling anyway.
Yep. So stick to the rules once again. Stick to your rules, regardless.
Usually the way, always can be an exception, but as a general proposition, following your trading plan, your trading rules is usually the preferable way to go.
Yeah, exactly. So yeah, just remembering obviously that any of the stocks that we show, past performance doesn't obviously equal any future performance, because they all look like some amazing investments you had there, Jason. So just that disclaimer, guys.
And also, I've just showed two of my best stocks. Actually, the two best stocks over the past, since 2015. And I did that because I was making the point. So it's not to say every stock you buy is going to do that. They're the outliers. They're the ones that really can make a huge difference overall to your portfolio, and that's why it's so important to maximise the gain from them when you get them, and let them run, and not short circuit that profit potential by rushing in and taking profits at your first 20% gain. But most stocks will not do that, and that's okay. We don't need every stock to do that. We only need like the 80-20 rule. 20% of your stocks can do
80%
big double digits or triple digit returns. Your other 80%, well, you're going to have your losses in there, and you're going to have your battlers that just sort of like 5-10%, and then your middle rung stocks. That top 20%, that's where all the action happens. A lot of people have the misconception that every stock should be this, a portfolio should be full of 100% winners, but that's not the reality. The reality is that most of the work's done by the minority of the stocks.
Yeah, exactly. I think you're right there. Yeah. So this is a funny one. Betting on horses, is it better than trading, Jason? What do you get out of that, mate?
Well, I learned during my uni years. And this was interesting because I loved to punt when I was at uni, and it was a way I thought to make extra money, get good at punting. But and I kept a record of all my bets. I wanted to work out, was I actually any good at this? I'd have a few wins. I thought I'm pretty good. Then I have a few losses. I didn't know. For a year, I kept a record of everything, and I tallied it all up at the end of that year, and it was pretty much break even. And I thought, okay, well, I don't have an edge as a punter, so I left the left the horses as a social day and stopped punting. But then I've got a job into the financial markets, and there I've worked out, well, I actually can get an edge. This is different. This isn't just having a bet on the horses. I can look for setups, and I can use strategies that minimize my losses, maximize my gains, setups that suggest when the probability is in my favor to buy, and when a situation is best left alone. I couldn't do that on the horses, but I can do that in financial markets. So it's a completely different game. Some people will tell me, oh, you're a trader, you're a punter. But it's they don't get it, and they don't understand how you can use strategies in financial markets a whole lot differently to reading a form guide and looking at the jockey's colours. It's they're completely different. So I think there's a bit of ignorance from people who aren't across what we do, and they have these misconceptions, and they throw these labels around, which are often misguided.
Yeah, family and friends will be the first ones to judge, obviously, saying that all we're doing is gambling, right? But I think the beauty of trading is that there is things that within our control, right? So, and it's not a binary situation, right? Where you either your horse wins or it loses, or whatever bet kind you're going to have, right? There's one, it's on or off, right? Whereas at least with trading, you've got a little bit of control on how you manage your trades, right? So whether you can get out early or take a bit of profit, whatever it is, there is something in your control. Where it's gambling, it's kind of a lot. Probably not as much in your control, right? So I just don't think it's gambling at all. But yeah, it is to the people that don't understand, right? So this is a quick question here from Frankie. ATR stop loss. Do you use the high or the close to calculate the stop?
I use the high. It's you could use the close. It probably doesn't really make a whole lot of difference if you did a back test and you tested either strategy. I don't think it would make a whole lot of difference. It would make a difference in some situations where you get a stock. Maybe it's a lower volume stock where there's a big spike. Say it's a 20-cent stock and it spikes to 35 cents and then comes back and closes at 25 cents. That's going to have an impact on where the trailing stop is going to be. But for the most part, it probably doesn't make a great deal of difference. A little bit like, do you use the closing price? Do you sell when you're based on the closing price or the intraday low when a trailing stop is hit? It's like these little variations which overall tend not to make a great deal of difference.
Okay.
As long as you're consistent. I think consistency is the key.
Yeah, and obviously, I'm assuming the indicators would you'd be able to choose whether you want to choose the high and the low anyway, right? So just to be consistent, I'm assuming on the indicator. So, yeah. All right. There's another question. Assume a stock in 52-week high, entering an ex-dividend drop. Will you still exit?
A stock at I'm not quite across the question. So a stock at a 52-week high.
Why? Entering, then it goes ex-div. Will you still exit?
Okay. Yeah, that's an interesting one, and it's situations I've found myself in recently with a stock. I got a signal for it when ex-dividend the stock fell. Given the shakiness of markets, I didn't buy. I thought, well, okay, the stock's come back. I'll just see what happens, and it's since like edged its way back up. And I should have bought where the signal told me to buy. I don't think there's a hard and fast rule on this one. I think the momentum is still to the upside. The trend hasn't broken. The ex-dividend doesn't break the trend. It's just you just had a pause. So I think the proper course of action in the normal course of things would be to follow your strategy and buy, and because that trend has been up, and the ex-dividend is not a reversal signal. It's just an ex-dividend.
Yeah. I think These are a couple of questions here. We might leave these ones for next one, just to get off this topic and go to one of the questions that come in previously. And we'll get onto these other ones afterwards that have just come in now. But we'll get on to some questions that George sent in. I think there's a couple of quick ones here anyway. With a lot of false breaks on the 70-day breakout, would you use another indicator to see if the breakout is real or not?
Yeah, interesting question. It's like, I think the first point to make is that no strategy is going to work all the time. Like, just like we talk about, the market goes through cycles. Indicators, in a way, go through cycles as well, because those cycles are connected to what the broader market is doing. So with a breakout strategy, it's going to be most effective when the market's trending. So let's jump to a chart. Let's have a look at, get the chart back on the screen. So I'll get a chart of the, let's get a chart of the All Ordinaries. Okay, so I'm going to pop this on a weekly. Now you'll see some, you see these blue boxes. I was using this chart in my weekly strategy session that I do on Fridays, and the point I was making is that, so we're going through a period, been going through a period for the last 2 years, which has been particularly difficult. So the market, All Ordinaries, peaked a couple of years ago, and it's been a really tough time. And it's a time that people struggle because it's harder to make money. There are more losses. And I had a member of my motion trader service tell me a couple of weeks ago that he's been hearing people say that, oh, the market has now changed. We're in a different, something's different now. And my point was that I've been hearing people tell me the market has changed since I got into this in like 1991. And these, just look at the chart structure over the last couple of years and compare it to the structure over these other periods where we have the blue box. They're not exactly the same, but they're not dissimilar either. Each box is a period that lasts at least 1 year. And so during those blue box periods, a breakout strategy is not going to be as effective, because you will still get breakouts, but they're more likely to fall back in on themselves as the market is chopping sideways in this messy formation. So does adding another indicator help? And it's like, well, I'm already using a moving average with a breakout. So when I'm using breakouts, it's not just a breakout, it is coupled with a moving average. So just going back to, let's just go back to Kalex, that stock we were talking about earlier. I'm going to jump back to a daily chart and just go back to where the initial break happened. It's like, yes, there's a breakout, but the breakout's also coupled with the moving average. So I'm actually using the breakout as a confirmation to the averages. So I want a stock, I want the moving averages to cross, I want the price above the moving averages, then I want the price to break to a new high. So they're my 3 checkpoints: the rising moving averages, price above the averages, and then the breakout. So they're the three points. Do we add another indicator in as well? And I think adding another indicator in, you then run the risk that you start to complicate the process. The more indicators, the more complicated. And the other thing is, we don't know. So just looking at the at this weekly of the All Ordinaries again, the problem we have is we don't know when these difficult periods start, and we don't know when they finish. We only know that in hindsight. So when do you use this extra indicator? You don't know until afterwards. So I think the key is that it's all about for me, it's about keeping things as simple as possible, avoiding the complexity of having too many indicators, and then just being consistent and letting your process do what it does. And I've accepted that I'm not going to get perfection, and I think we all need to accept that there's going to be no perfection in this. There'll be periods when our approach is less effective and it does lose money. And that's why we have strategies to reduce risk when things are going against us. And the aim is to be able to ride out these unsuitable periods, which we have in blue, come out the other side when we get these larger trending periods, and be ready to take advantage of them, because we haven't lost all our capital in the difficult period, and emotionally just burn ourselves out.
Yeah. So I think we had a chat about this once, actually, and this might lead to this next question, Jason. I know you buy on the breakout, right? That's your way of doing things, and I tend to, through previous education, one always like a bit of a retest. And I know you may have just touched on that now. I don't use an indicator for this, but I wait for it to retest just a level, and then get some more positive action again before I enter the trade. If it just continues, if it goes down and continues going underneath the moving averages, I take it off my watch list. What's your thoughts around a break and a retest, which I know people will be familiar with if they're into these technical analysis?
Yeah, look, it's the challenge sometimes can be when you get a signal a stock has advanced quickly, and we can be hesitant to buy something which has advanced quickly, and that's where the appeal of pullback towards the moving averages can be a strategy to consider. Some stocks just keep running. So if you make that your standard strategy, chances are you are going to miss some stocks because they will continue to run. But there'd be times when you do look at a stock and look, I like this, but I'd be more, I think waiting for that pullback would be more comfortable. I think I'll see if I can find a couple of examples. So let's just get the chart back. Call up a company, Smart Group. Let's see whether this gives us an example. I'm going to go back to a daily chart. So this has been a motion trader signal this year. So this is sort of situation you've mentioned where, okay, so we've got the moving averages cross, the shares go on a run, and I think this is actually a motion trader signal back in February. So got a situation where the share price has been through a declining period, it's below the moving averages, we're not interested, starts to form a base, starts to push higher, gets above the averages cross, so we've got a tick, break to a new high, we've got a tick, but now you might be looking at this, and just like this is how it would have looked at the time, going, oh, it's had a bit of a run, maybe I'll see if there's a pullback. And as often happens, there is a pullback towards the moving averages. So as you're saying, Roger, that can be a point where someone could consider buying back towards these averages, or they could wait for it to come back to the averages and then start to rally off it. That would probably be the way I'd approach it, because there's nothing to say that it's not going to just cut straight through the moving averages and keep going lower. But one way or another, somewhere around this pullback phase can be an entry opportunity. And you can see there have been several times where Smart Group has come back towards these averages. It rallies back towards the averages, rallies back towards the averages. We're having another period now where it's come back towards the averages and starting to rally again. So whether that was an opportunity or not. So I think there's one more example I can think of, GPK, because this is one I think I've used this strategy myself. So this was a motion trader signal, and I got a signal to buy it as well. And I remember I initially missed this one. Where was the signal? Yes, I think the original motion trader signal was back in November last year, and for whatever reason I think I had things on. I just overlooked it. I missed it, and then there's this gap higher. I didn't want to buy. I thought, oh well, I'll wait and I'll buy if when the share price comes back to the moving averages. And over the next few months, it did. And I think I ended up buying a position in January. Maybe it was around this point, which I'm marking on the averages now. I bought a position then, so I ended up being able to get that position in the stock. And the thing was, for me, there was it was an asymmetric entry point in that I could buying as it comes back to the moving averages. Below the moving averages, it starts to hit the trailing stop. So it was relatively low risk, and the upside was quite open. And as we can see, it's had a good run. So I think a couple of important concepts there. Make sure the risk reward stacks up if you're going to buy as the share price is pulling back, and just know where your risk is, and make sure there's plenty of upside in the situation.
Yeah, thanks there, Jason. Just a reminder, guys, please like and subscribe. We'd love you to do that, and comment if you wish. Don't forget to send us some shares you want us to look at as well. We've got one which we'll have a look at soon, which someone sent us in. All right, so thanks for that. Kirby says, many of my best trades I've had never retest. They just go. That's why Jason is the best at what he does, because he just puts it on with no confirmation, no waiting, and that's why he's probably got an amazing portfolio to suit. So yeah.
No, well, look, everyone gets things wrong. So I was just with GTK. I was just saying I missed the initial big move because of being distracted with other things. I can't remember the situation, but yeah, we all missed stuff. And that's right. Some of the best stocks are just out of the gates and they just run. They don't pull back. So that's why I was kind of saying a little bit before, you've got to be a bit careful with that. Wait for the retest, because some of the best stocks don't retest. They just keep going, and they can run quite a long way before. Look, eventually you get a retest of the averages, or they come back to the averages, because the averages are a bit like gravity. They eventually, the market will come in at some point. It's not just going to skyrocket and never see the averages again, unless it's a takeover situation or something. But in the ordinary course, the averages will be revisited, but you don't know when. It could be a fair bit further down the track. So sometimes it may be better to at least get some position on the initial signal, and then you can top up on the pullback to the averages. But yeah, that's a very good point. You've got to be careful, because some stocks don't come back anytime soon. They keep going, and you can miss stuff. And that's happened to me. I think it's probably happened to everyone, just saying, oh, I just wait for a pullback, and the pullback happens 50% higher, and you're just going, oh,
why not get in it?
I should have just bought when I had the signal. So you've got to be careful around that sort of management of an entry.
Yeah. Well, look at and once it just comes down to your trading plan as well. Like, what are you doing, right? So are you just going in at the breakout, or are you waiting for the pullback? And that's part of my trading plan. So got to live with it if I can't get all the ones that break out and never come back, right? So and not be too emotional about it. So I think that question was kind of answered. In general, if a stock does have a false breakout, how much room do you give it before breaking? Let it drop below the 100 moving average and get out? How much room? I'm trying to make sense of that question. In general, if a stock does have a false break, how much room do you give it before breaking?
Yeah. It's a good question, and it's going to vary. I think it's going to vary depending on what it is that you're trying to achieve. Like, what's the time frame that you're looking at? What's the like? Are you short term? Like, if you're short term, your stop's going to be at a different point for a breakout potentially than if you're taking more of a medium term position. And then also looking at, like, what's the upside potential, that, like, where you say a break has not played out. It can vary depending on, like, what your upside is, your time frame, the particular setup itself. Have a look at a couple of examples. I think maybe that's the best way to play this. And the stock PPM, it's a recent motion trader exit. So this was a loss. Stock called Pepper Money. And so this is a breakout situation which didn't work. So we had a stock, it's had a pretty ordinary time below the averages, but then it started to look like it was maybe forming some sort of a base. We got back above the averages crossed, got a breakout to a new 70-day high. So we had momentum starting to move forward, and there was a motion trader signal, but as some trends do, it stalled quickly, and it fell. Now, this blue line is the motion trader stop loss. So this is where it hit its exit point. I think it was just this week. And so, like, where do you cut? So this is the thing with a wide trailing stop. Now, a wide trailing stop, one of the aims of that, it gives the stock room to move, and it reduces the activity that you need to do in your portfolio. If you've got close stops, you're going to be a lot more active doing stuff. But with the wide stop, it gives it room to move, but you do get a larger loss when it doesn't work. So depending on how you want to look at it, like if you're using a systematic approach where you're using like a calculated trailing stop, that is your process. You've got the calculated stop, so you wait for it to be hit. If you're using a more of a calculated but a discretionary type of exit, perhaps maybe you'd see the price fall back below the moving averages, and it might be a point to reconsider. But I've got another example of why it's not always that clear cut. It's also a motion trader exit from the last couple of weeks. It's a stock called Lindsay Australia. It's a logistics company. So this is actually quite similar to Pepper Money in that we got a breakout, moving averages had crossed, got a breakout to a new high. The stock does then have a pullback towards those moving averages. It's quite a deep pullback. It goes beneath the averages and it has a couple of excursions lower. So a close stop strategy would have been taken out, whereas giving it room to stabilize on this occasion has worked well, because as we can see, Lindsay's then gone on and more than doubled in price, just hitting its exit stop this week, just around about $1. So yeah, it can vary depending like how you're playing it. Are you calculating a trailing stop, or are you're just looking at the averages and trying to work it out as you go? A way I like to look at it sometimes is, I'll give you another stock, OFX. So Odds Forex is a good example of how I might look at it from a discretionary perspective. So again, a motion trader signal, broke higher, moving averages broke higher, looked like it was going to do something, momentum failed. So it's this point here where I may start to question whether an earlier exit is necessary. So the stock's fallen, it's beneath the moving averages cross, and then the stock starts to break down again after this sideways consolidation. So that's very much a red flag that this stock is going to is heading towards its stop loss, and over the next month or so, it actually did continue lower and hit that stop. So it's you can never know for sure, but there's some of the warning signs of when a break is going to fail.
Yeah. All right. Now here is the question that everyone's been waiting for, Jason, and I'm going to paraphrase this a little bit. It's a bit of a loaded question, so I'll put them all in together here. But in your motion trader system, what has been the most run of losses that you've had? I guess that's consecutive losses that you've stopped out. I don't know if you know this, but as I've read somewhere that there's a 50%. If you have this 50% strike rate, the chances are you're likely in some stage of trading to have potential 16 losses in a row. I think a lot of traders wouldn't be able to stomach that. Out of your 30 years, how do you stomach that? How do you manage this situation?
Yeah, like losses, a series of losses, like a run of losses, is always a possibility. A lot of it's going to involve what phase the market's in. Often these string of losses can happen after a market peaks and prices start to come back, because as the market is rising, you'll be getting entry signals.